Lots of economists are thinking that the Bank of Japan is going to end its easy monetary policy in 2024. We're going to have a look at whether there's any merit to that idea at all. And then at 9:30 this morning, we've got the UK PMIs, Purchasing Manufacturer Index numbers coming out. We're going to see whether that shows that growth is indeed contracting in the mid to longer term. And then the trading takeout today is going to be trade what is obvious. Before we get into today's video, make sure you like and subscribe to the channel to ensure that I'm in your feed every single day so that you can maintain your trading edge. So we're looking at this headline today that says Reuters poll shows 21% of economists think the Bank of Japan will begin to unwind ultra-loose monetary policy in January next month, while 84% expect the BoJ will end negative interest rate policy in 2024 versus 71% in November poll and 54% in October poll. 88% of economists expect the Bank of Japan to end yield curve control policy, and 12% think the Bank of Japan will tweak again. There's not really much I can say to this other than economists are economists because they never put risk on the table. Very rarely do I actually listen to economists because the problem with economists is that they rely way too much on theory. They're not very forward-looking. Right now, it might seem, for example, that, this is all the adequate things to be doing when it's not, in my view. I think this must have been taken before Ueda's comments just last week, which I think we spoke about on this video series, where Ueda said that he wasn't really concerned about doing anything to monetary policy. He said that wage growth wasn't necessarily an issue. And perhaps this was taken before, the GDP print, which showed that Japan's growth was actually contracting this quarter. So I wouldn't take this to be that much of a signal of, okay, this is true. I would take it more as a contrarian signal. And I think, if we were to look at dollar yen, for example, let's get dollar yen chart up. There's not really much follow through just yet of the push lower from last week. If you were to look here, this is the 200 daily moving average. We are actually below the 200 daily moving average now, which is interesting. But at the same time, I would still suggest that this is, an accumulation of orders just down at these lows. So what we're focused here on is really, okay, well, what is the potential for the Bank of Japan to act in any way? Right now, for me, the probability is tilted to keeping policy exactly the same, because you don't really want to try and be the hero and say, okay, well, they're going to change policy from something that they've done for 20 years, especially when their balance sheet is so large. So what is the more evident play? Well, more evident play is more of the same. Now, the one broader risk, I guess, to dollar yen here is if the US policy does indeed ease quite rapidly and the Japanese policy remains the same, because then what you're seeing is a narrowing of yields, which contracts the differential between dollar yen and makes it more attractive then to go, or it doesn't make it more attractive to go into yen, it makes it less attractive to be in dollars relative to yen, if that makes sense. So then you would see a push lower. So we're at an interesting point, because I love the 200 daily moving average. I talk about it a lot, but it has to be in conjunction with the broader macro events. Like if you're testing here, but now you get an event that is very, very weak, the yen, and you see dollar yen rally, then that is going to be a kind of a very bullish signal. If it's the other way around, then it's quite a bearish signal. So I like to use this as a point of flipping in conjunction with, the macro events that might occur. So make sure that you're looking at that, because I think dollar yen is a very interesting pair based on how far we have gone over the last, say, 2 years. So at 9:30, we've got UK flash manufacturing, UK flash services, and the UK flash composite PMI. Big risk here is if we start to see a slip on the flash services, because that's been holding up GDP quite a lot. Flash manufacturing already in contractionary territory, and the expected is to remain in contractionary territory as well at 47.5. Flash services in expanding territories at 51. And the flash composite at 50.9. Now we got that poor, not poor, it was in line, but we just haven't had any growth over the last 6 months. It was 0% on a quarter just a couple of days ago, and it was negative 0.3% for October, which is not good. It's really, really not good. Is it October or November? One of the months, I can't remember. I think it was October, wasn't it? Of course it was. And so, yeah, it's just not very inspiring at all, to even have maybe even negative 0.1%, that might induce some sort of activity to stimulate the economy. But when it's 0%, it's like, oh God, it almost seems worse than going as slightly negative for some reason. I don't know. But it's very, very languid, and anything on the UK flash services PMI should be a net negative here, I believe, especially when it comes to looking at sterling, because what that would invoke is really a reversal of that move that has occurred throughout the front part of the week. Excuse me, I've got a really itchy nose today. A reversal of that move that's occurred through the front part of the week. And we'd probably be looking at touching levels like down here and perhaps even this one here, which I think I highlighted the other day. Because what that would mean is that the Bank of England are more likely to hike. We saw that more likely to cut. We saw that 3 members yesterday wanted to hike, which made no sense to me. And it would kind of reverse their views, in my opinion. So if we saw a weak number on the PMIs today, I think sterling will take a bit of a hit. We'd probably see here get squeezed through and here. Ooh. So we probably look at those 2 levels. Now I'm just going to quickly check on my sentiment indicator just to see. So the market is slightly long as well. Retail is slightly long the market. So not massively. So it could potentially mean that we squeeze up to the high and then tick lower. But what you'd want to see really is, sorry, I haven't been sharing that tab. This is where we're looking at on the levels for cable. What you'd really want to see is this to happen. If we do get a weak print on the PMIs, because that would show that, that pricing out of any of those rate hikes has occurred. Just gives a clearer picture, creates more parity with the dollar after the big dollar move earlier in the week. And it means that, we might be able to go some way at clamping down on, this poor effect that we have with regards to growth. If you have a weaker currency, it can stimulate a little bit more. So we'll see. It's all dependent on those PMIs. I think they are kind of becoming more and more important as we go along, as the growth story resurges rather than the inflation story. So let's see what happens at 9:30. Here's a really strong piece of advice for you for today's Trading Takeout, and it is always to take the most obvious trades. And the reason why you should take the most obvious trades with the most obvious ideas or backing behind them is because it allows you to mess up more. You're never going to get execution of anything right. But if you're taking something that is really out there in terms of, okay, I can see that this is going to work out, which it can happen quite a lot, actually, if you really drill down into your process. You're allowing yourself to mess up more. You're giving yourself space. You're giving yourself leeway. And that's so important in something where there's so much pressure to do well at every single component. So make sure that you can refine down to what is obvious to allow yourself to mess up.